Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. I'm not going to spend a lot of time on this. Everything is green. The different sectors, cyclicals and tech, financials leading. Again, typical risk on move. Defensive utilities lagging. Atypical risk on move. 3% up on the S&P, 3 plus on the Nasdaq, and nearly 3% on the Dow. Let's get right into the meat and potatoes of all of this, the S&P 500 daily chart. And I have some major concerns here, everybody, that I'm going to point out straight away. The first is this. We're getting really close to a bullish crossover on the PPO, but we're not there yet. Tomorrow is going to determine whether this is a fake out bull trap or whether this has some more steam left. And I want to point out two examples. One is here, where we failed to get that bullish crossover, and the next day we ended up dumping, gapping down, and having one massive sell-off. Another example that I want to point out is this. We did end up getting a bullish crossover, but the next 2 days we had a significant sell-off. Now the difference, guys, between this situation and this situation is pretty simple. If we get a bullish crossover, this low will likely hold. If we do not get a bullish crossover, just like what we had back in May, this low will probably get taken out just like what we had back in May. So these are the two situations that I'm looking at. If we get a follow-through day tomorrow and we close green and we close up and we get a bullish crossover, that does not mean that we could not get another dump, another sell-off, an opportunity for more bulls to get in, because this was too much, too fast. I do not like these kinds of rallies. Even though I was bullish, even though last Friday we warned everybody, do not short into the hole. There's going to be a massive short squeeze coming to trap and slaughter the bears. That's exactly what happened. Even though the majority of retail traders, the majority of YouTube financial channels and videos were calling for a 2008 style crash, a liquidation break, whatever you want to call it. We were absolutely not in that camp. We warned this was a bear trap, and we ended up getting that bear trap and then some. Look at this, guys. Just look at this move. We had a $20 move in 2 days. This completely wiped out all of those short-dated put options, those extremely aggressive bears, every bear on margin. All of those guys are completely wiped out. This is the danger of shorting into the hole, and that's what we were talking about. Now the market is switching into a bull trap, not a bear trap, a bull trap. I do not like this move. It's too much, too fast. We need to get a breather. And so I would not be chasing this. If you caught this at the bottom, congratulations, you made a lot of money. If you're looking at this now, I'd be way more hesitant to go long. Now let's jump into the HYG. The smart money is up top. This is the high yield bonds. The dumb money is down below. This is the stock market. Yes, the stock market is the dumb money, and the bond market is the smart money. It's just a much larger market, and big money plays in this market. So what do we have here? Well, how did we spot the bear trap? Well, we had this divergence. The S&P was selling off as the HYG was making higher lows. We warned everybody this usually resolves to the upside, and we had that resolve to the upside in a very violent move. As of right now, I'm not seeing a bearish divergence. The S&P's closed in a very large green candle. The HYG did the same. At the beginning of the day, we were looking more like this, and that was very concerning. But look at this. The close of the day was very powerful. And so I think the S&P still has some more room to run. Just be mindful that at these levels, we could still get some pullbacks, some sell-offs to allow for more bulls to enter. So the risk to the upside is now shrinking dramatically. The risk to the downside is now expanding. And so just be very careful at these levels. We're now entering no man's land. It's not clear whether you should short or you should go long. If you caught this early, that's good. If you're now looking at this for a long position, I would be very careful. And if you're looking at this for a short position, I would still be very careful, because we haven't seen any bearish signals just yet, not even divergences. Let's take a look at the VIX. Again, guys, the VIX has pulled back, and I'm watching this. We're getting extremely close to a bearish crossover on the VIX. We need to see this crossover completed by tomorrow. If we don't, we could still see another spike to the upside, flushing all of those Johnny come lately bulls. So again, be very careful. If we get a bearish crossover on the VIX could still move all the way down to this level in the mid 20s, and that will allow the stock market to rally even more. Let's take a look at the dollar, everybody. The dollar crashed just as we expected after we saw this breakdown of this prior resistance line. Here it was a support line, a very weak support line. It broke in 3 days, and we said, everybody, look at this. This has been taken out. The market will rally to the upside, and the dollar will move to the downside. We still have some more downside risk on the dollar index and more upside risk on the S&P, but we're getting, again, very close to that no man's land where the lines are getting a little bit murky between going long and going short. Just be very careful here. You don't have to participate in every rally and every sell-off. If you find the right setup, take it. This bear market is all about capital preservation. You want to come out at the other side of this bear market with as much of your money saved up, not lost, so you can buy on the other side. It's not about making a lot of money on the way down, everybody. It's just about saving as much money as possible, protecting it from losses. Let's take a look at the CPC put to call ratio buy and sell signal. We had the early buy signal here when we crossed below 1.1. By the way, guys, this buy and sell signal, I've been working on this signal for weeks, trying to perfect it, trying to eliminate any false signals, and I ended up figuring it out. It's a bit complicated to set this signal up. If you're interested, check out the link in the description. I posted a member exclusive video for our Discord trading members in the Discord trading community. It's 20 bucks a month. If you want to support me, that's the best way you can do it. And I also share a lot of technicals that I don't in the videos, simply because I don't have enough time to go through all of my technicals in the videos. So you'll find a lot more technical signals in the Discord trading community. You'll also find all of my entries and exits in real time, and all of my investment ideas and trade ideas in real time, as well as real-time technical analysis. So please check out the link in the description if you're interested. If you want to support me, that's the best way you can do it. Another disclaimer, everybody, I will not be able to cover the market tomorrow. I am in the middle of a really big relocation move. I'm relocating to a completely different country, and I'm shipping out a lot of things, and I have a lot of things coming up. So I will not be able to cover a lot of the market in the videos. But if you're part of the trading community, I will continue to cover the market every single day in real time. So again, guys, if you do not want to miss out on the technicals, check out the link in the description and you will be set to go. Now, going back to this CPC buy and sell signal, I've been working on this signal for weeks and weeks and weeks. And finally, I figured out how to eliminate all the false signals. We had an early buy signal back here, guys, really, when we broke below the descending wedge and we crossed down below 1.1 on Friday. So as early as Friday, as the divergences were building, the CPC buy and sell signal did confirm an early buy signal, not a confirmed signal, an early buy signal. Let me point out the differences. This is a confirmed buy signal. We get a cross down below 1.1 and a crossover on the PPO. This is an early buy signal. We get a cross down below 1.1, but we don't get a crossover. In this example, the market rallied and then had a sell-off and then rallied again. Okay, so we're still in this risky zone where we don't know if the market is going to continue to rally or if it's going to put in one more green day and dump. So we're in a very risky place. Again, it's just a couple of days. Watch what the market does and you'll get the answer. You don't have to jump into anything. At this point, everybody, I have a very tiny position, a tenth of my usual position, simply because I recognize the risk at these levels. So what am I looking at here? I'm still waiting for a crossover on the PPO. I'm starting to get the sense that this is a bull trap of sorts where we could fill this gap here, this prior gap that we had. This is an acceleration zone, what I call an acceleration zone, um, where we have gaps and quick moves. So we could easily gap up tomorrow and move to 380 plus. And we could easily also gap down tomorrow and sell off. So what is going to determine that? Let's take a look at this, guys. This is the economic calendar for tomorrow. And it's this, the OPEC meeting. The OPEC meeting is going to take place at 8:30 a.m. Eastern Time, so before the market open. So get your sphincters ready for some really violent moves in the pre-market. If the production cut is successful, if it goes through, oil will shoot to the upside, and the stock market could see a dump. I'm not sure what is going to happen with the stock market yet. A production cut in oil is very inflationary, and so it is bad for the market, but the market could absorb it. It could shrug it off for a day or two, and then the dump could come. So we don't know for sure if the market is going to sell off on this news or not. But what we do know is that if the production cut is successful, if it goes through, oil could still move to the upside even more, all the way up to $90 on a US oil WTI. That's my target. If we get that production cut, that's what I'm expecting. Back to the CPC buy and sell signal. Again, I'm waiting for that crossover. If we do not get that crossover, and if we start to see some really weird action like a gap down, some selling into the open, I'll be very careful at that point, guys, because that would indicate to me 1 second dump, maybe forming something like this, a double bottom. We'll see. I'm very suspicious because this does not look to me like a sustainable bottom for so many reasons. Number one, we sold off into the close, and then we gapped up the next day, and then we just ran. We just squeezed and squeezed and squeezed. All the shorts got absolutely obliterated here and squeezed. And so this is not a sustainable bottom because the bears did not get the chance to exit and the bulls did not get the chance to enter. This is just too much too fast. I don't like these sort of moves to the upside. And so I'm still a little bit weary, and I would be more inclined to wait for a pullback. Now, these green and red lines, these are my price action expectations based on seasonality. It's not based on anything other than seasonality. Seasonality indicates that we will rally into the middle of October, perhaps into the last third of October, and then get a massive dump and take out these lows. This is based on seasonality, nothing else. I just wanted to draw out seasonality on the chart so it's easy to follow. This green line is also based on seasonality, and it indicates a rally of, let's see, about a 20% move in November and December, closing at $400 by the end of December. So we'll see if seasonality plays out or not. Trading a bear market is like driving on the road. If you see a pothole, you swerve, you stop. If you see an accident, you stop. If the weather gets really bad, if it starts raining and then hailing and then snowing, you stop. So you have to adjust. You have to adjust here and there. You have to keep adjusting. You can't just stick to one plan and go for it. You will have to keep adjusting. So even if you were long here, you would want to continue to adjust, perhaps take profits at these levels, and watch for tomorrow's open and close. I also want to talk about the 10-year yield. Look at this massive dump as soon as we broke below the 9-day EMA right here at the open on October 3rd. I warned everybody, this short squeeze is going to continue to rip as long as the 10-year yield and the dollar index cool down, and they still have some more room to cool down even further, go down some more. Now, I do not think that this is the top on the dollar. I think we'll see some weakness in the dollar. I just don't think that this is the top. I think we'll see the dollar go even higher next year. The yields, everybody, got a bearish crossover the last couple of times where we had a bearish crossover. Let's take a look at what happened with the stock market. Look at that. We had a bearish crossover here. We still sold off significantly. Here, everybody, after we got that bearish crossover, it confirmed this bottom, and then we rallied. At this point, we really don't know. We're either here or we're here. And the way to find out whether this is going to be another bear flag and we move to the downside, or whether this is the bottom for the year, is simply to wait and look for confirmation over the next few days on the price action on the S&P 500 as well as on the CPC put to call ratio buy and sell signal. Now, if we start to see the put to call ratio start to move back up, and if this crossover fails, I'll be very worried that this is a bull trap. So be very careful out there, everybody. Tomorrow, again, we'll have the OPEC meeting. We'll also have the services PMI as well as the employment change. So jobs. The market was rallying off this weakness in the jobs market today. On Tuesday, the actual number came in significantly below the last reading and significantly below consensus and forecasts. That's bullish for the market. A slowdown in the economy is bullish for the market because it is deflationary or disinflationary. So a cooling down in the jobs market is good for inflation. It allows inflation to continue to cool down. So we'll see what happens. We have the employment change and we have the OPEC meeting. So Wednesday is going to be wild. Again, watch for those gaps to the upside or to the downside on the day, and for continuation on volume in the first hour of trading. Again, if you want to continue to follow my trading activity and my live coverage, check out the link in the description to join the trading community. I will be on and off for the next, let's say, week or so as I figure out my relocation. In the meantime, thank you, everybody, and I'll catch you the next one. Bye-bye.
Oh, wow.